All right, welcome everyone to the fundamentals of investing. Today we'll be talking about different asset classes, kind of thinking about your risk tolerance and how to look at asset allocation and choose a portfolio that's right for you in terms of a mix of stocks, bonds, and cash. This is our last webinar in the rotation that we do quarterly. So we'll be starting again next quarter with basics of financial planning, but this is kind of the last one in the rotation. What we'll be talking about today are motivations and reasons for investing, goals and risk tolerance, types of investments, and how we think about them in terms of the risk and return trade-off, and then asset allocation and a little bit about rebalancing as well. As we go through the presentation, feel free to put questions in the chat or in the Q&A, and I'll get to them as we go. For questions, do try and keep them generally applicable. If you're a little bit too specific about your situation, then it might not be something that is applicable to everybody, but any kind of general questions about something you don't understand is appreciated. So let's start with reasons for investing. So fundamentally, in investing, there are a few very important things to remember. One is time is your friend. Get started early, and it can do very good things for you in terms of building your wealth. When we look at returns we get for investments over some period of time, they are exponential with respect to time, not with respect to how much you have invested, but it's really the time that compounds on itself and can really help you build wealth. Another thing is diversification is key. We don't want to be owning any, just one investment with a lot of our portfolio, hopefully not even one type of investment. We want to be diversified among geographies, countries, industries, things like that. And as we're thinking about portfolio construction, time horizon is a big thing. When do you need the money is going to indicate to us how much risk we want to take, but also our behavioral risk tolerance. This is just how much we can deal with our portfolio fluctuating in value, because often it will go down when very scary things are happening in the world and it feels like things might get worse. And we need to be able to stick with our portfolio through that. And then we'll talk about asset classes a little bit later as well. So one of our motivations for investing is maintaining purchasing power. Cash is very good at funding expenses today and expenses tomorrow and the day after, but it's not so good for funding expenses that are 30 years or more in the future. So if we have an expense that today costs $200,000, we have $200,000 to purchase things that we can purchase today, and assume a 3% annual inflation, then after 20 years, that's going to be worth more like $109,000. And if we look at something that's 40 years in the future, it's a little under $60,000 worth of purchasing power. So again, we want something that has more growth, even if it fluctuates in value a little bit today, to help us fund those far future expenses. Cash and low risk things are good to fund expenses now, but things that are more volatile in the short term can help us fund those long-term expenses. Another fundamental, like I talked about, the growth is exponential with respect to time. So say we have $5,000 and invest that every year for 30 years, assuming a 6% annual growth rate. what you'll see is that at the beginning of our journey here, we have a pretty flat curve. We're really just going up a little bit. Contributions are driving the growth of this account balance at the beginning, but by the time you get to the middle part of this curve, around year 15, 17, we are starting to really experience a lot of growth from what we've already put into the account. And then eventually even the growth on the growth is really what's driving our investment returns. So even with a pretty modest rate of return, we can be looking at making a good amount of money over a 30, 40-year time horizon. So let's look at goals and risk tolerance now. Investment goals are important because we decide how we're going to invest money based on what types of goals and what the timing for those goals are. Some investment goals that are very common are retirement, funding education for yourself or kids, purchasing things like homes, cars, maybe a wedding, something like that. And then you can also have some more potentially nebulous goals like financial security or feeling comfortable, or just having enough for kind of the unknown unknowns that life throws at you. So we like to think about whether goals are short-term, long-term, or something in between them. Because in general, we can afford to take more risk when we're thinking about longer-term goals. So when you're thinking about how should I invest, the answer, unfortunately, is kind of a question in and of itself. It's like, what is the purpose of this money? What do I need it for? When do I need it? Those are the types of things you should be asking. This is important to understand your risk tolerance when thinking about investing as well. So we talked about time horizon. Risk tolerance is more the individual, can you sleep at night, or how much anxiety do you have about the fluctuations of your portfolio value? A lot of our decision making is driven by losses and fear of losses. And some research has shown that you would need to gain like 5 times as much to get you the same amount of happiness as a 1x loss. So it's about 5 times as painful to have a loss as to get a gain. So thinking about what your personal risk tolerance is, we want to know this because there will be down markets in every portfolio. No portfolio always does well. And it is better to have a more conservative portfolio that you can stick with rather than kind of shooting for the fences, even if you have a long time horizon. So risk tolerance and how much you can tolerate fluctuations kind of puts a cap on how much risk you should take, even when you're talking about long-term goals. And we just have sort of a definition here. An aggressive portfolio might be one that's like 70 to 100% stocks. About 40 to 70% stocks is a moderate portfolio, and 40% or less would be a conservative portfolio. So this is, I think, helpful to think about the risk-return trade-off. And again, I just want to be clear, the type of risk we're talking about is like how volatile your portfolio is in the short term. There are a lot of kinds of risks. And what we're talking about is that volatility, the uncertainty of what your portfolio will be a year from now. Not so much will it be enough 30 years from now. So we like to use a normal distribution because they're a little bit easier to understand than some other statistical tools, but Models are not reality. This is a pretty good model for understanding short-term risks. So we often use standard deviation to measure the risk of an investment portfolio. A higher standard deviation means that we have a higher level of volatility. So if you want to think about this curve as like all the potential returns that we could get, we have one standard deviation encompassing about 68% of the time. We'll have, within one standard deviation of returns here. We calculate it based on historical performance of asset classes. And then for a 95% chance, we can encompass two standard deviations. So what this means, let's look at an example, is if we had an investment that gave us an average return of 6% and a standard deviation of 10%, that there is a 68% chance that it is plus or minus 10% from this 6%. So we have a 68% chance that we get between a 16% and a minus 4% return. And then we have a 95% chance going out two standard deviations, so 6% plus minus 20%, of getting between a 26% and a minus 14% return. So that's kind of a classification for how investment returns work in this sort of risk-return trade-off. As we're looking at getting a higher expected return or mean return in this distribution, we should expect more variance. So even though we have a higher expected return with this 8% portfolio, the chances that we get a minus or like strongly negative return are also higher. That's the risk that we're taking on. So what types of investments are higher risk, lower risk, and how do we look at that? So types of investments that we have are mutual funds and ETFs. We'll talk more about these in a little bit, but these are kind of baskets of investments or things that follow a specific investment strategy for us. In terms of some individual investments, we have cash alternatives like CDs, money market funds. We have bonds, we have stocks, and then we have non-traditional or alternative investments. And then we'll also look at a very specific case of mutual funds called target date funds, because these deserve a little more attention since they're almost always the default option in your retirement plan. Something to note is the investments that go inside of accounts are not the accounts themselves. So 401ks, 403bs, IRAs are not investments. They are tax-advantaged accounts that hold investments inside them. And you can also have taxable brokerage accounts like non-retirement accounts that hold investments inside them, or health savings accounts. And I mean, there's a lot of different types of accounts that can hold things. So looking at mutual funds and ETFs or exchange-traded funds, these are great tools because it is actually very hard as an individual investor to go out and build a good portfolio of stocks yourself. There's just a lot of things to pay attention to in terms of staying diversified and rebalancing. So we use these tools where there's someone else managing something that we can buy into and invest our dollars kind of pooled with other investors. We're investing in a specific strategy or set of strategies. You own a portion of the security and kind of get that diversification from whatever the fund is. A few examples of tickers that do this. QQQ is investing in the NASDAQ 100. VTI and VSAX are total US market investments. This is the ETF version, VTI, and VTSAX is the mutual fund version. And then FMAGX is the Fidelity Magellan Fund, which is like an active, large companies US type mutual fund. Looking at kind of major investment categories, we have money market funds, bond funds, funds that are a mix of stocks and bonds, and then we have stock funds. Something that I think could be argued should be here also is real estate funds. In this presentation, we'll talk about real estate a little bit more as an alternative investment, but that's kind of a function of that we tend to own some real estate by owning stocks, like companies own the land and buildings a lot of the time. So we have a fair bit of at least commercial exposure to real estate already. Funds fall along this risk-return spectrum. So money market being the lowest risk but lowest potential for return. Bond funds being the next lowest risk. Balanced funds that are maintaining a combination of stocks and bonds are kind of between bonds and stocks. And then stock funds being kind of the highest potential for return and highest risk. And potentially you can even get into what types of stocks have higher expected returns and higher risks. And so there's, within all of these, there's also variation. Advantages of using mutual funds and exchange traded funds. I'd say the largest one is the instant diversification that you get. It's very hard to own portfolios of thousands of stocks yourself. Really nice to just have that professional management. You may not have enough money to buy shares of all of the individual things that you want. So it's nice to be able to get into something that's a little more manageable in terms of the price. And depending on the type of investment, it could be an advantage that these things are sold either daily or live at any time, depending on whether it's a mutual fund or ETF. Disadvantages, the value of the shares can fluctuate daily. It is technically a little bit less tax efficient because if you had the individual investments, you could make sure to sell things at a loss along with things that have gained and sort of be a little bit more tax efficient with your selling. I don't think realistically this is a huge disadvantage. It would be extremely hard to maintain that portfolio yourself. But one thing that definitely is true is you do end up paying extra expenses for management of the fund. And this is something that we do want to pay attention to in investing. So paying a low fee for these sort of things is definitely often worth it, but fees do matter. You do not get to keep the money that you're paying in fees for investment management. So what's the difference between mutual funds and ETFs? Both are pooled investments that have similar options, both have fees and expenses, both offer easy access to diversification. The main sort of differences between them are that mutual funds only trade once a day. At the end of the day, you can just tell a mutual fund how much money you want to put into it, and it will always take that full amount and invest it, so you can always buy it in fractional shares. You can identify them because their ticker symbol ends in an X. And there's sort of this historical thing that they've been more actively managed, higher fee type funds. I don't think that's a terribly good metric, but historically that has been true. And likewise, historically, ETFs have been more index-based, more sort of just following an index like the S&P 500 or something else, do tend to have a little bit lower expenses. They trade like a stock so that you can, buy it immediately. You don't have to wait till the end of the day. But unless you have a broker that supports stocks with fractional shares, you have to have enough money to buy a whole amount. So there might be some cash left over after what you want to invest. And ETFs are a little bit more tax efficient. Mutual funds, based on what happens inside the funds, can distribute capital gains to you at the end of the year. So if you're in a non-retirement account, there is reason to prefer ETFs for tax efficiency. Looking now through our asset classes, what things are cash alternatives? Certificates of deposit, money market deposit accounts, money market mutual funds, and then short-term treasuries, or like super low risk government bonds that have a very short duration. The advantages to these things are there's a low risk to your principal. You can sell them, at any time for kind of what you expected to be able to get for them. And they have predictable earnings and interest. Disadvantages are they have low returns. They may not keep up with inflation. So we like these for funding short-term goals, having an emergency fund, a remodel for my house I want to do next year. If we're looking at shorter-term goals and we want to know that the money will be there in the amount that it currently is showing on the account, that's where we really like to have cash and cash alternatives. Moving up the risk spectrum, we have fixed income or bonds. These are loans that we give to a government or corporation for some period of time. They are rated based on the creditworthiness of the issuer and how likely they are to be able to repay it. So there is some risk of loss in these things, especially if you're talking about individual bonds. The interest is paid at regular intervals. I'd say the most common are like quarterly and yearly. They can be traded like any other security. There is a secondary market, so they're still generally liquid, but there is risk of some loss of principal, and I'll explain why in a moment, but examples of these are like treasuries, bonds that you give to a municipality like your city, bonds that you make to corporations. And then there's this kind of separate classification of junk bonds, meaning that they're paying a high interest rate because they're risky. And, that is something you should expect to be compensated for because there's a much higher percentage of the time where you don't get the full value back. Advantages are they provide steady and predictable income. Typically, you're committing to loan an entity money for a longer period of time, so they have higher returns than a cash alternative or something that you could sell for its face value at any time. Lower risk compared to stocks and low correlation with stocks so that they work well in a portfolio together to kind of provide stability. Disadvantages, there is a risk of default, definitely lower return potential, and then the value and income can fluctuate based on interest rates and market conditions. This is a little bit, so if you're talking about an individual bond, an easy way to think about why the value might fluctuate, if I loan the US government $1,000 at a 4% interest rate for the next 10 years, and then interest rates change to 6% being the norm. That thing that I loaned them $1,000 to get a 4% return. And now that anyone else can go out and give $1,000 and get a 6% return, my promise of getting 4% over the next 10 years isn't going to be as valuable anymore. So interest rates can change, as well as market conditions, kind of making the risk of default for bonds higher, can definitely change their value. But the shorter the duration, generally the better they'll hold their value, but also the less return that you expect. So we like bonds to provide income and stability for short to mid-term goals, looking at, between a year and 5 years from now sort of thing. And then kind of last on our list here is stocks. This is an ownership position in a business. We actually, having a share, own some percentage of the business and all of its profits and losses. We're not obligated to pay, the worst it can do is go to zero. You're not obligated to pay any of its losses beyond that point. Earnings can be distributed as dividends. Not all companies do this. Shares can be sold at a gain or a loss at any point in time. Some terminology you might hear around stocks is small, mid, or large cap. Means the capitalization of the company is the total value of the company, thought of as the number of shares outstanding times the share price, or at least that's how much is externally owned of the company. Growth versus value can be measured by the ratio of the earnings produced to the current share price. A more growthy company will have a higher price per current earnings it has because the company is expected to grow those earnings, and that's sort of priced in an expectation of growth. Whereas value will have a lower multiple. There's not as much growth priced in. An income stock pays dividends regularly, and a blue chip stock is an established, more profitable type company. Advantages of stocks. Probably the biggest one is that this is the asset class that, as far as public markets go, at least has the highest expected return. It's pretty simple to buy and sell. They provide some income through dividends. There's also some tax advantages, like capital gains rates and qualified dividend rates are a little bit lower taxes than ordinary income. Disadvantages are these are subject to the highest degree of market volatility. If you're thinking that you'll have your principal tomorrow, this is the kind of investment where there's the greatest risk it won't be there, which is why we don't like them for short-term goals. Emotional turbulence due to volatility, especially if you have a low risk tolerance. This can be a huge issue, and it's just overall risky for short-term goals. So we like these for long-term goals, growth, and have historically very much outpaced inflation. A few notes about individual stock positions, because we generally, when we're thinking about these things, we're looking at funds that own a diversified portfolio of those in an ETF or mutual fund. So when thinking about individual positions, you can't buy them in your 401k or 403b, like employer retirement plans usually don't let you buy them. They can if you have like a brokerage link option. But if you have a non-employer retirement account or a taxable non-retirement account, you can buy individual securities. Can potentially be exciting to own specific companies and get your feet wet if you'd like to learn a little bit about individual stocks. but they can be very emotional to watch in terms of value. And I guess I would also say there are several reasons to limit your portfolio to a small amount in individual positions. We're thinking like 5% or less of your portfolio, depending on how much itch you have to do these sorts of things. You should be okay with losing that money. When you're looking at an individual company, the chances that it goes to zero are much higher than owning a diversified portfolio. And I guess I would say just my personal experience with people is, with human psychology, is like, expect to be disappointed by your performance in individual stocks. Because even if the stock doubles its value over the course of the year and you sell it, and that's objectively you've done very well, you'll probably watch that stock. And then if it doubles again the next year and you sold it, you'll feel disappointed even though you've objectively made a really good investment. So I don't like them from an emotional point of view so much. Some other types of more alternative investments. These are things like real estate, commodities, collectibles, crypto, derivatives like calls, puts, those sorts of things. These are basically, we're calling everything outside of stocks or bonds this. Generally not advisable for long-term planning. Be cautious and understand the risks if you're going to invest in these things, or any kind of like, I guess another thing that would be here is like private equity and private credit. Many of these things can be either illiquid, like you can't get your money when you want it, or very volatile. We do, owning real estate in a portfolio is fine. I'd say out of these asset classes, they look most like stocks. The problem with real estate as an alternative is if you're planning to buy it directly, it's very hard to get it at a scale that's diversified. So if you want it in your portfolio, you should look at like a real estate investment trust, or, there's things that mutual funds and ETFs that hold a diversified portfolio of real estate. So I don't consider that an alternative, but owning it directly kind of is, because it just has so much undiversifiable risk about what happens to that home and that location and that market. Looking at kind of what the structure is of investments in your employer retirement plan, we look at various tiers. For people who like to delegate investment decisions, we have the target date funds. We'll talk more about this next slide, but this is sort of a one-size-fits-all solution, does pretty much everything for you, does all the right things that you would want to be doing as you go through your career. So for people who want to delegate that decision, there is a good default investment option in place. Then at tier 2, we have some options for people who are more fine-tuners. And there's all kinds of reasons the default option might not be right for you, or you have a really unique situation, or you just want to manage things a little bit more yourself. And there will be kind of a stable principal fund there, a core bond fund or core fixed income, US, and then international equity markets for you. And then for people who really want to get into the weeds and customize, there is a tier 3 extended array where you can potentially get US and international fixed income. You can start playing with your mix of large and value and small and large cap stocks, add real estate if you want. And then for international equity, potentially also having small, large value growth as axes that you can play with kind of look at all those mixes together. Again, there are reasons you might want those things, but the target date funds are a pretty good default option. So let's talk about kind of why and what those do that is kind of the right behaviors. So target date funds are a mix of stocks and bonds, internationally diversified, so they own thousands of companies worldwide, as well as internationally diversified bonds, and kind of keep a mix of stocks and bonds to target a specific risk profile, and that risk profile changes as you get closer to retirement. And that's what the date is in the target date fund. So it's a full portfolio that is targeting an appropriate retirement age of whatever the date on it is. So if we look at Vanguard's 2055 target date fund, it's about 50% stocks, 50% bonds, because 2025 was last year. Like we're in retirement now. We want a relatively conservative portfolio. If we look at the 2040 fund, retirement's still about 14 years out, so it's got about 75% stocks, 25% bonds. And if we look at the 2070, it's got about 90% stocks and 10% bonds. And this is about as aggressive as they get. So the idea is that when you're early in your career, you can take a lot of risk. There's a really long time horizon for your money. And then as you approach retirement, kind of walking down the age here on the y-axis, it'll add more bonds to your portfolio and give you a more conservative portfolio. So the 2040 fund, once we get to 2041, is going to look exactly like the 2025 does today. So these are just really nice. They do the right things for you. They get more conservative over time. They do rebalancing for you, which we haven't talked about yet, but is something that's kind of hard to manage for investments for a lot of people. They just kind of do all the right things for you, so you can just set it and forget it. Once you've figured out when you want to retire and how much you can be saving, it automates everything else for you. So we really like that. As far as the investment types and asset classes, are there any questions there? All right, I'll keep an eye on the chat in case we do have some more questions. But kind of our last major section is asset allocation. So when we're thinking about how much money we want in cash alternatives, how much in stocks, how much in bonds, what kind of things do we want to be considering? So one is our time horizon. How long is it until we need this money? This is something you need to kind of constantly be evaluating because, you know, this year you may not see any sudden large needs for cash upcoming, but next year you may decide on a $100,000 home remodel. And when you do, you might want to move some money out of stocks if that's money that you're planning to spend in the near future, so that you know that that principle's there, because the stock market's volatile. If you're talking about something this year or next year and you're counting on that money being there, you don't want it in stocks. That's for longer term things. We also want to consider our risk tolerance. That's our ability to stick with the portfolio through ups and downs, and just how much emotional turmoil we have when there's turmoil in the markets. One way you can get an idea is by doing an online risk tolerance questionnaire. It'll walk you through some different scenarios and help you see kind of what your risk tolerance profile is. But ultimately, you don't really know until you've experienced a large market downturn what your risk profile is. So that's how you'll ultimately find out. So if you've been through some, think about how you felt at those times if you were looking at your portfolio. But otherwise, a risk tolerance questionnaire is about the best you can do. For diversification, we want to limit our exposure to single companies or single sectors. For example, we don't want to be invested just in NVIDIA. We don't want to be invested just in tech stocks. Ideally, not even just in the S&P 500 or US stocks. We want a globally diversified portfolio. And then another thing to consider is just liquidity needs, and that's what tells us how much should actually be in cash versus bonds. How much money am I planning to spend, this year and next year, essentially, or what kinds of expenses do I foresee might come up that I would need to get access to money immediately. So let's look at a few different portfolios that we could go through. This is our conservative portfolio. So conservative asset allocation is focused on preserving principal and providing us with lots of liquidity. You notice that we have a nice big quarter chunk in cash and 50% in bonds, which are more stable, and then about 25% in stocks. So this portfolio is focused on maintaining that principal. It's good for short-term cash needs, or maybe transitioning to retirement or a period of heightened uncertainty. This is what this kind of portfolio is appropriate for. Or for someone with a very low risk tolerance, if this is the portfolio you can stick with, it might be the right portfolio for you. Although you're going to have to save a lot more for long-term goals, like 20 plus years than a more aggressive portfolio. A moderate allocation looks more like this, where we've got about 50% stocks, 40% bonds, and a 10% cash sleeve. This will be appropriate for kind of if you're in a position where you're trying to balance predictable income with potential growth. You still have some need for liquidity. That's what that 10% is there for. But you want to not be fully experiencing the volatility of the stock market. Best uses for this would be kind of closer to retirement, or if you have cash needs 2 to 5 years from now. And then again, if you have a lower risk tolerance, this might be as aggressive as you ever get, because it's better to have a lower return portfolio you can stick with than have a higher return portfolio where you will bail out when markets get volatile and the world is scary. Also, do note we're going to do an example of why rebalancing is important in a couple moments here. So this moderate portfolio is sort of our base case for that. An aggressive portfolio is primarily focused on growth potential. We still do have a little bit of need for liquidity. We're still having a little bit of bonds in there for stability of the portfolio. But this portfolio is 75% stocks. It's mostly focused on growth. That's what the stocks are there for. This is good for long time horizons and planning for 10 plus year time horizons, like retirement for most people. So this is an example of what happens to portfolios when you don't rebalance them. So looking at portfolio drift, over the long term, stocks tend to outperform bonds. So we're starting with the moderate portfolio. We've got 50% in stocks in orange here, 40% in bonds in blue, and 10% in cash. This is sort of a historical example. So if we had that portfolio in 2010, and then we didn't do anything with it until 2023, we would now have a portfolio that's more aggressive than the aggressive portfolio because our stocks outgrew the bonds and cash. So now we have an 80% bond, 80% stock, 17% bond, 3% cash allocation. This means by doing nothing, just letting our investment sit, we've taken on a lot more risk over time because of the growth of those stocks outpacing everything else. So we want to sell off 30% of those stocks to replenish our bonds and our cash so that we're at the same risk level. This is what rebalancing is all about. If you have your own portfolio, you generally want to be doing this, at least yearly. Or you don't have to rebalance yearly, but check if anything is too far out of whack, at least yearly. And this is one of the things we really like about target date funds too. As you're looking at let me go back to the target date fund slide, at any given point that you're at on this curve, if stocks outperform, then the fund will keep you at that risk level, selling the stocks, putting them into bonds to get you back to whatever your target is for that age. And likewise, if we have a down market and stocks go down, we will sell some bonds to buy back those stocks to get us to the risk level that we're targeting. So that's kind of what rebalancing is about and why we like to have funds that do that for us as the default option. All right, any questions about asset allocation? All right, well, that's all I've got for you guys today. So you guys all have a great day, and feel free to send some questions to me if you have them.